Hi, good morning, everyone. Good morning. How is everyone today? Happy to spend my Saturday morning with you. Too bad I can't interact with you via the chat, but apparently we can interact via Slido. So my name is John, and today I'm going to present to you quite a insightful topic that I myself, when I embarked on the research, was quite amazed by the data. And the topic is really about how to find 10 baggers in Malaysia. Now, I'll explain what is the meaning of 10 baggers very shortly. So who am I? I actually run a social media space where we help people under 40 level up their wealth through stocks. So I'm on the right and my partner is on the left, MJ. So if you want to know more about us, go to that website. We have a YouTube channel called Viral. You know, it just stands for Finance in Real Life. Just head on to our YouTube channel, click like and subscribe. You know, we produce at least one content every week. Right. So we always start with a disclaimer. Every time we come into a presentation about stocks where there's in so-called investment advice, I think we always put a disclaimer that we are not here to give advice. It is purely for educational purposes only, and it is an opinion of ours of when we do research and what we find as interesting case studies. So please do not take this as advice. Do speak to a licensed professional or your financial planner if you want to solicit any stock advice. All right. So what are the key takeaways of today's session? And I'll explain it in four main chunks. The first takeaway is what is a bagger and why is it important? The second thing is the 7 criteria of what makes a multi-bagger. The third is actually why are these criteria actually very, very important to you as an investor? And the last, and I think most important part, is the skills and strategies that you need to look for the next multi-bagger. I can't talk about the future, but I can show you hints of what these companies look like by studying the past. Right? So what is a bagger? It's actually a term coined by Peter Lynch in the 1980s. One bagger just stands for 100% gain on your stock. So if you bought the stock at $1 and it turns into $2, that is considered one bagger. If the stock from $1 turns into $10, that's considered 10 baggers. Now, if you guys have never heard of Peter Lynch before, do check him out. Just Google him. I highly recommend 2 of his books as beginning reading for the value investor, actually. All right. So how do you want to ask questions and interact with me on this session? The link is there, slido.com, #hall2. If you have a QR code scanner, scan that QR code on the right, right? You should be able to see the questions coming up. As I do not have a feedback directly in my Zoom chat, I would only know your responses through this Slido. So I haven't even done the check whether you can hear me clearly or my video is clear. But you know, if you can't, please go to Slido and give me that feedback. All right. So before I proceed as well, as good fiduciary duty and part of the CFA charter, here I'm disclosing the stocks that I own so that you do not have any false pretense that I am front running or giving you biased advice. All right. There's no advice here. It's purely opinion on my own. Right. Now, so this is the place where I want you to interact with me, guys. And if you can see the chart, there's 2 charts here, chart A or chart B. I'm giving you an option, right? Between chart A and chart B, which represents the stock market, which one would you buy? Which one would you buy? If you have the link to the Slido, which is here, all right, I'm going to hold it here for a while. Please answer me whether you would buy company A, chart A, or chart B. Okay, guys? Give me an answer whether you're going to buy company A or chart B. Okay? Right. Chart A or chart B. Thank you. Thank you for your responses. Great. I'm seeing the responses come in. Why not chart B? Just to give you an indication, it's 4 to 8. That's double, you know. This is probably 160 to 230. You know, the gain is much bigger in chart B. Don't you think so, guys? Right. Thank you. I'm seeing the responses now. Great. AB. Right. Thank you for it. A lot of these guys are anonymous, so I can't address you by name. Sorry about that. I see Edward and Farid's name. Great. So obviously you guys can hear me loud and clear as well as see my slides. So that's good, right? Now, we're going to begin with the 7 criteria of what makes a multi-bagger, or in this case, 10 baggers, okay? So the feature companies we're going to talk about, and please, guys, this is not a buy or sell call. We're using them as case studies, okay? Case studies. So it will be QL Resources, Yinsen, Press Matter, SKP, Time.com, and MyEG. One bias that I have to share with you guys first. I'm a very proud and happy customer of Time. All this while I've been using Unify when I first moved into my condominium, but after using Time, there's no turning back. Okay, so I'll put it out there first. Okay, that's my bias. I'm a very happy customer. Okay. So this is the kingdom of the 10 baggerdom. Now, this list is not exhaustive. There are many more companies in Bursa that has achieved what we call 10 baggerdom. That means their stock price has more than 10 times the IPO price, okay? So QL, it took them 10 years to 10x from 2000 to today, right? Yeah. So it's 10 times. So 62 times since the year 2000, okay? Another company, Yinsen, how many years did it take them to 10x? It was 3 years. QL was 10. Yinsen was 3. And they have achieved 29% since 2006. Press Metal, and I know a lot of investor or trader favorite, all right? It took them 9.5 years, and it has 110 times since its IPO. So 1 ringgit become 110 ringgit, okay? So there's a lot of perception, especially today, our political scenario, that Malaysia is a very bad place to invest. I look at the data and I beg to differ. And this is actually a good testament to what certain companies that have certain characteristics can return to you in your investment portfolio. The problem, and the biggest problem, and I'm not ashamed to say this, is investor skills. Investor skills, because a lot of times people who lose money do not want to put in the work, do not look at the right data, do not have the skills to look at the right data, and want shortcuts. And I can tell you 95% of the market fall into that trap. And do not expect easy money whenever you invest. If you want easy money, I think there's better luck going to Genting or buying 4D, right? I think that is an easier way to achieve your, in a way, wealth if you don't want to put in the work, right? So SKP, Time.com, you guys can read. Yeah, we're going to cover these companies today, right? So what are the first criteria of part of this 7 criteria is small market capitalization. Okay, what does small market capitalization actually mean? So market capitalization is the value of the entire company. So let's just say you're a billionaire today, you have probably 100 billion. And when you want to buy a particular company, that is the price tag of the company. It's the entire company's value that is presented to you on the stock exchange. Now, for those of you who are unfamiliar with this term market capitalization, I know there's a lot of veterans out there, but bear with me because they may be newbies in the session. Market capitalization, the formula is pretty simple. It's just the price per share multiplied by the number of shares. So if you have $1 for the price per share, if you have 1 million shares, that means the market cap is 1 million. All right? When we say small, why do we need it to be small? Because it's so much easier to go from 60 million to 600 rather than 6 billion to 60 billion. Even though both 10x, but the magnitude is much difficult to achieve if you are already that size. Okay. Now, there are certain companies in the US that grow to trillion-dollar companies. I have no doubt that can happen. But in Malaysia, our population size, the business that we're in, I would say the probability is less. I wouldn't say it's impossible, but it's less. Okay. Now, how small is small? Small cap definition is a market cap of 750 million and below. Now, the definition differs among professionals, but that is the range. I think the Edge actually put this club called the Edge $1 billion Club, which I'll discuss later in the presentation. But I think that is somewhat of a cap of a small market cap company. All right. So before they started their journey, these 6 companies that we're going to cover all started definitely below 750 million. QL started their journey at 100, Yinsen 157. I think the smallest looks like MyEG at 69 million in 2007. All right. So the second criteria is actually this thing called a growing total addressable market. Now, how I would explain addressable market is this. Think of it as if you're going to swim in a swimming pool nearby, or you're swimming in the South China Sea, or you're swimming in the Pacific Ocean. So obviously, if you swim in the Pacific Ocean, it's dangerous to us because it's such a big ocean. But 2 listed companies, the bigger the market size, it shows the potential of growth for that particular company. So if that company is only playing in a swimming pool size market, can you imagine how fast, once it grows, how fast it will hit its limit? And that's why understanding total addressable market is actually, for me, one of the most important criteria when you invest into a company. If you're going to grow a chicken, but then you put it in a very small cage, the moment it hits a certain size, the growth will stagnate. That's the reason why understanding TAM is very important. All right. So I'll give case studies or examples of how to visualize a TAM. Shrinking TAM, stagnant TAM, and growing TAM. So 2 companies that Malaysians are very, very familiar with. The first is actually the Star newspaper. All right. I think when I was growing up, it was the default newspaper that we read. Right. You want good journalism, especially if you are a secondary school student, you also see a lot of articles that were, I think it was the Star Rage or something. I think it was a very good initiative to encourage readership among the young. But today, in today's day and age where everyone has a smartphone, everyone is so connected to the internet, how many people actually buy printed newspaper today? Now, I don't need a response from you guys, but you guys know the answer, right? That illustrates a shrinking TAM. The second TAM I like to illustrate is actually called a stagnant TAM, which is spritzer. Now, I don't think everyone is going to rush out to buy mineral water because it's the next revolution or the next electronic product that you want to get your hands on. I think even smartphones have a bigger on a non-stagnant TAM as compared to, spritzer, you see? So when we look at a TAM, we want to define what we call a growing TAM. A TAM that is probably, let's say, the Atlantic Ocean today, and then it may grow into the Pacific Ocean. So to give you an example, a case study example, is actually this company called MyEG. Now, I'm pretty sure most Malaysians would have heard of it, but for those of you who haven't heard of it, have never studied it before, one of the earlier things that they did was actually the road payment digitization services. And today they also do foreign worker permits. I'm going to focus more on the road tax payment digitization first, okay? So in 2007, there were 23 million vehicles on the road. 23 million, right? Whether they're old, new, whatever. It's all right. 23 million that needs to renew road tax. Now, we all know that you need a valid road tax to drive on the road, right? So a typical road tax, I would put it at a median of 70 ringgit. Now, don't worry whether it's accurate or not. I know there's some guys who say, hey, but if you buy a Lamborghini, then the road tax would range from 16,000 to 10. It's okay. We average it out. How many Lamborghinis are on the road, or how many Ferraris are there on the road? So we average out, we say, let's be more on the pessimistic side, right? 70 ringgit per year for probably a car under 2 liters on average, right? And this is 2007, guys. So if we were to multiply 23 million vehicles with 70 ringgit, the amount of road tax being paid is roughly about 1.6 billion, all right? Now let's assume 10% of that goes to MyG, 10%, right? 7 ringgit. That TAM alone is 161 million as of 2007. 2007, guys, today we're in 2020, right? Today definitely is higher. And this excludes all the foreign worker permit sales, right? The revenue for MyG in 2007 was 25 million. Remember, TAM 161, revenue 25 million. Was it a monopoly? Yes, it was a monopoly business. So the TAM is 6.5 times that their existing revenue just for road tax. Don't talk about the other services that they're going to spawn. Okay. So there goes to show you a good illustration of a growing TAM. They're just at the nascent stage, the beginning stage of that growth, you see. All right. Now, some would say that, wow, John, are you giving me hindsight? Everyone can be perfect in hindsight. Was it impossible to find this number of registered vehicles in Malaysia then? I don't think so. I don't think it was very difficult to Google. Even if Google didn't exist, there were other search engines like Yahoo that you can find them. Was it impossible to find the average road tax payment? If you were not driving back then, probably you're a graduate or, you haven't gotten your license, you could probably ask your parents, hey, Dad, how much you pay for road tax on average, right? And last but not least, and I think this is a very important characteristic, is that do you need to be 100% accurate on these figures? As I've proven to you, you don't. I'd rather be roughly right than accurately wrong. Don't worry about so much accuracy because no one's going to give you, no researcher in the world will be able to give you 100% certainty of the numbers. But if you get a collective basis or what we call back of envelope basis, I think is good enough to size up the TAM, right? The third criteria is this thing called moat. Now, for those of you who are unfamiliar with the term called moat, it's actually a body of water surrounding a castle. And I think Warren Buffett, a famous investor, a lot of guys actually explain moat in relation to investing and why is it important. When you have a big TAM, the likelihood of the company growing their sales, capturing market share, it's good, it's great. It's almost like a sure win. The problem is, let's just say we use the example of social media. Social media is definitely booming, but not every social media company will do well, right? Look at guys like Friendster. Look at guys like MySpace. What happened to them, right? They came and they went. What differentiates these guys is actually the moat. You need to understand what is the durable competitive advantage of these companies to know whether they are likely to win. I'll give you an example off the top of my head, which is actually Facebook. Now, for those of you who are probably below 30s, you would look at people like me or elder who have a Facebook account that's old school, that's old generation. Everyone is on Instagram or probably TikTok, the younger generation. Now, when Instagram first started out, Mark Zuckerberg, with his vision, he was very sharp. He saw the potential of Instagram and he bought it for $1 billion. Now, in hindsight, people will say, wow, was it very expensive? No, in hindsight, at that point, people will say, wow, it's very expensive. What was the valuations he paid for it? Did he overpay? But he knew that by buying Instagram, he could conquer 2 markets. And he knew the durable competitive advantage of Instagram, right? And here he has capturing 2 demographics already, right? I only shared one kind of moat today. Actually, there are many, many moats. And we cover that in very detail in our stock investing blueprint program, okay? This cost advantage moat is something I want to share as a case study today. Now, company can price products cheaper and competitors cannot do the same. A classic example is the company that I said that I was biased to, which is time.com. So if you look at it on a cost to cost comparison basis, right, for 500 megabytes, a Unify would cost you 249 ringgit a month. I know, those guys living in landed houses, you can't get access to time. I'm so sorry. Those guys in condominiums, provided which condominium you are in, then there's no brainer virtually. For the same speed, very little latency, you get probably half the price. Okay. How does this happen? It's very simple. Time focuses a lot on what we call high-rise residential or high-rise buildings. Now, why is that an advantage as compared to Telekom Malaysia, the incumbent telecommunications company in Malaysia? Is because TM has to serve even areas that are very far-flung and has less population density. In time, I pull one fiber, the cost to pull one fiber, if I'm not mistaken, when I spoke to the IR, it costs about 100,000 per kilometer, right? Or maybe more, I'm not too sure today, to lay that fiber into a high density condo. But the moment they lay that fiber into a high density condo, there are easily thousands of units that can be the subscriber. Talk about scale. When TM actually pulls a fiber to probably a place in, let's say, Ulu Kapit in Sarawak, right? How many subscribers can actually subscribe and pay back the costs that TM incurred laying those fibers? So there goes a very big difference already. All right. Hope you guys are clear on this. The fourth criteria is actually owner, operator, and skin in the game. I love this criteria the most because if the owner owns a big portion of the company, his or her wealth is determined by how well the company does. And if you tag along with them, you're enjoying the ride of their hard work. Okay? I'll give you a case in point. People only care and when they have the most to gain to make it work. All right? And I'll show you, remember that the list of 6 companies that have made it into the 10 baggerdom? These were the ownership of the families that own these companies. Like, look at QL. More than 50% is actually owned by the Chia family. Yinsen, Lim family owns more than 30%. Press Metal, 59%. Close to 60% of the company is being owned by the Kun brothers. SKP, Gan family owns 47%. Time.com. Now, if you guys actually study a bit of Time.com history, I think we covered it in our YouTube videos a few times. I think one done by my partner MJ, and another one we talked about it when I think just 3 weeks ago. You can check those videos for a more color on the history of Time. But Time really turned around when Afzal came in, and he owns 30% of the company. Can you see the incentivization for him to turn it around? A good indication today is actually Jalil, right, who is taken over the Berjaya group, running of it, the CEO-ship. And with Tan Sri Vincent stepping back from day to day, I'm very curious to see how Jalil executes it. And he has skin in the game because he's bought some substantial shares into the company. So something to watch, right? Last but not least, Wong Tian Soon, majority owner of MyEG, owns 32%. The fifth criteria is actually high ROIC. Now, I'll describe ROIC as return on invested capital. Why is this number important? It is a measure to tell you how efficient company is managing capital, right? So, to illustrate this point, okay, once you see a higher ROIC, it is actually expressed in percentage form, right? Once you see a higher ROIC, you can quickly tell whether the environment and the management has a certain execution discipline. And when they have that execution discipline, you will see that the ROIC and the share price will actually grow in tandem over time. So if you see ROIC growing at 23% per year, for example, right, there are some peaks and troughs for the share price, but when you stretch it out over the long run, you will notice that good companies with good ROIC, their share price will grow in tandem. So ROIC growing at 23%, you will see share price growing at 23%. Okay. What is high? Now, I mentioned 23%. I already set the benchmark to be so high, right? Actually, most companies, for them to grow capital at 8 to 10% is already very, very good, to be honest. Normal. It's very normal. That's why you see most ETFs, LCI index, most mutual funds will give you returns of around the same area. Don't believe me? Check out the US, even the US ETFs or Malaysian ETFs, right? They would grow anywhere between 8 to 10% on the high side, right? Anything that is double digit or 20%, to be honest, you really have to take your hats off. You really have to salute these guys. It's amazing, right? So I'm going to give you an example of ROIC for SK Press, okay? Now, for those of you who are unfamiliar, there are actually EMS, or it stands for Electronic Manufacturing Services Contractor. What they do is, you think of, okay, the world's biggest EMS is actually this guy called Foxconn. So Foxconn, they box build iPhones and Apple products for Apple. They get all these components from all the various supply chain manufacturers. They will box them, build them, package them, and they will actually provide these services for big guys like Apple. Now, SKP in the past, they were very focused on a lot of electrical appliances and other electronic appliances. And prior to 2009, they had, I can't remember the name of the client that they had, but also a very big client. They did not have Dyson as their client prior to 2009. And even then, on certain years, they managed to get a 23% return on invested capital. Very, very commendable. To be honest, if you look at EMS guys, if you look at Foxconn, their margins are ridiculously thin. You're talking about sub 10%, sometimes even sub 5% margins, net profit margins. For someone like SKP to be able to give a return on invested capital of that in a very competitive environment is really hats off to the management. Now look what happened to them when they got the Dyson contract. 2010, just look at it. You can see a very stark contrast in which Dyson clearly contributed to better efficiency, better capital management execution discipline from SKP, right? Now, the average before Dyson was 13.76. The average after Dyson was actually 29%. Can you see the similarity in the share price gain to the average ROIC of them securing the Dyson contract? Right? Can you see that similarity? Now, if you ask me, I said, John, it makes it sound so easy, but a lot of people don't put in the work. Why can't people spot this? Yeah, because a lot of people don't put in the work to crunch those numbers. It's as simple as that, right? Here's the average. I actually crunched the numbers for all, but I realized I couldn't squeeze all the companies we studied. It was more than 50, but we couldn't squeeze everything into one chart. So I'm going to show you some of the outstanding guys. Look at MyEG, guys. Return on invested capital of close to 100% for 2015. More than 100%, sorry. Not even, yeah, close. It's more than 100%. On average, look at the return on invested capital. Okay. Six criteria. They must be selling to you when you buy them at reasonable valuations. Now, how do you value a business? The simplest valuation method is actually how many multiples are you buying a business for its earnings. Earnings, okay? So I'll give you an example of two coffee shops. Coffee shop A on the left, excellent decor, very hipster. Coffee shop B on the right, probably something your mom and dad or your grandparents will go to, right? So both these coffee shops are selling to you for 10 million, okay? Between coffee shop on the left or on the right, which one would you buy it for? Now, I don't know whether you guys can access Slido. If you can, please give me a response. The company on the left or the company on the right, guys? The coffee shop on the left, coffee shop on the right, okay? if you guys are still awake and still can respond to me on Slido. Okay, seems I think you guys can't respond on Slido. Don't worry. Actually, there's a missing element here. The element is actually left, right, left, right. Great. Thank you for participating, guys. Thank you. Right, left, coffee shop, left, right. Okay. Actually, there's one very important criteria that's missing here. It's actually profit. Now, what if I told you now that the company on the coffee shop on the right profits 5 million a year and the coffee shop on the left makes a profit of 1 million a year? Now, would you change your mind now? Would you change your mind now between the beautiful one or the slightly uglier one? I guess you guys know the answer, right? You see, I want to illustrate this because most of the time when you see the stock market, right, what is the perception of the coffee shop on the left? It must be pretty, it must be nice. And in the stock market, what is pretty is something that has risen in price. The price has risen up, then we chase. Coffee shop B on the right is the stock that has probably gone down in price. Nobody's talking about it. Everybody hates it in the market. But then surely and sustainably every year it churns out 5 million profit. Okay? See the difference, guys? So what I'm trying to illustrate is that when you buy a business, don't just look at the appearances. Look at its potential profit. Because when you're buying something at 10 times valuation of its earnings versus that 2 times its valuation of its earnings, which one are you going to recoup your capital faster? Now, what I mean by recoup, you put out 10 million, every year coffee shop on the left gives you 1 million a year. So that means it takes you 10 years to get a return on your money. Coffee shop on the right, you put in 10 million, within 2 years, 5 million, you already return your invested capital. Obviously, the guy on the right makes perfect sense, right? So what is reasonable? The lower, the better. The lower, the better. If you can find a company that sells to you for 10 million and they made profit of 10 million, please do let me know too, because I want to be an investor in that company as well. Okay? When you compare it, you should compare it against the stock average. So what I'm saying is that any company you look for, Apple, and you want to compare to MyG, right? And you want to say, oh, Apple is selling for a PE of 20 or 30, but then MyG is selling for a PE of 10. I'm just giving hypothetical examples. I should buy the lower one. No, that's not the way you compare. What you should compare is, if you're looking at a company like MyG, you should compare with other companies that are in the same business space and what are their peers' valuation. You cannot take a Nestle PE and compare it to, let's just say, Berjaya Auto PE. They're in 2 completely different spaces. You need to compare against its peers so you know what other people are paying for similar kind of businesses. Okay? So this is a very interesting chart. I think among all the charts that I'm going to show you, this is one of the most important that you should pay attention to. So the blue stepped area, right, is the average PE of the KLCI index. Okay? The average, I repeat, the average PE. So in 2001, the average PE of the top 30 KLCI index companies was 20. So as you can see, the years when it went down, there were years when it went up. Now, why I want to benchmark this is I want to show you companies that were great, doing well, but selling below the average PE. So as you can see QL here, I want you to notice, forget about the green bars first, forget about MyG first, right? I want you to look at the red bars first. Look at the red bars, guys. Here was this QL resources, just diligently making sure we can buy eggs, making sure there's enough fish meal, making sure there's palm oil, right? Here they were diligently just churning out profit year on year, but yet selling below the average KLCI index, right? And when you see that, right, you should be able to seize that chance to say, hey, this company is growing every year, but selling below the average valuation. right? Shouldn't it jump up at you, right? Look at MyAG. Now, MyAG is interesting is because I wanted to point this out for MyAG is because what happened in 2019, guys? What happened in 2019? Or even 2018 for that matter? We had a change of government, right? And when that change of government happened, there was a lot of bad perception about MyAG. Oh, they're going to lose the contract, they're going to lose their road tax division. And yeah, here you go. Look at it. Was it so battered down? Yes, it was. Now, you as a value investor, right? I'm not saying that you should, if your choice is a value investor, you should start swimming and hunting when there's blood in the ocean. Sorry, I have to use a very gory example, but you should be very, very greedy when the market is red. And you should be very, very wary when the market is green. So today the market is red. Open your eyes, guys. Do the work. Crunch those numbers. You will find very interesting finds. Trust me. Okay. So last but not least is the PE growth. So the moment a company is discovered, right, suddenly everyone wants to pay a premium for it. Definitely it's great to buy it before the premium increase, but if you can spot it even after the premium has increased, right, you are still may not be too late to the party. Okay? I'll show you an example. Remember QL I talked about? This was the average, what do you call it? KLCI PEs. And here we were just quietly humming along. And then in 2015, someone at the Edge featured them under the Edge $1 billion ringgit club. What happened? The next year, they opened Family Mart. What happened after that? Look at the PE jump, guys. Everyone says, oh, QL is a great company. But when everyone else was not looking at it, this is what happened. Now, Taufik, don't worry. I saw your question. I'm going to answer that later. I know the moderator just helped me keep my attention and putting it. Don't worry, I'll answer that. Please ask me at the Q&A session. It's a very good question, by the way, Taufik. Okay. So this is what happens when it's suddenly discovered. The best part is you want to buy when it's undiscovered. And that's where the work comes in, guys. Okay. So this was the PE growth before and after each company. 10 to 55. There's not much change to Insen, hint. Okay. P Metal 10 to 34, SKP 9 to 18. Usually it's double or triple. Okay. Time.com, okay, it increased but not as a substantial double. And MyG 20 to 31. All right. So the conclusion is this, guys. The signs were actually very clear. If you do enough digging, the information for you to take action is all available. You just need to know how to dig, to possess the skills to know how to dig. Out of the 7 criteria, 5 was actually very easy to find. You just need annual report numbers, right? The struggle would be when you come to TAM and modes, and that's where you need to upskill. I mean, it took me years. Even today, I'm still learning how to evaluate TAM and modes better, actually. And this is where the thinking is required, because no one can give you an answer. You go to one research firm or you come up with your own calculation versus another guy, it will differ greatly sometimes. But here's what's interesting. You don't need to reach a consensus that you get an accurate number to give you a picture of the TAM and the mode, right? So the biggest challenge of them all is this. You need to be patient and emotional control. Now, I've had students come up to me and says, hey, John, your method very slow. MJ, your method very slow. I want to make money tomorrow. Yeah, if you want to make that 10, 20%, go in the morning and then afternoon, wow, I made 5% because volume is big. I went in $1 million and at 5% is already 50K, kind of thing. Yeah, whatever makes you happy, whatever that you feel that it's suits your style. But the style that I'm showcasing to you is that I'm looking for baggers. I'm not looking for the 10, 20%, guys. I'm looking for the 3x, 5x, or even 10x's, $1 to $10 kind of things. And I'll just be patient and wait. Do my work, be patient and wait. Okay? The problem is this. There's a lot of noise. There's a lot of market commentary. I'm pretty sure even today, if I'm not mistaken, Afin or Am they're also doing their market day. And I know a lot of retail investors. They love to attend this market outlook. It's great that you attend. It's great that you look at economic data. But what are you guys doing on your own? Are you crunching the numbers on your own to be able to give you that conviction? Because if you're not, a lot of these market opinions and commentary, the moment one day an analyst says that the target price is $6, and then 3 months later changes the target price to $4, and you've not done the work, that's where you get easily shaken, guys. And that's where it will cause you to sell. That's why the struggle for most investors is they haven't put in that work to give that kind of confidence. And ironically, numbers only make up 25% of your investing decision. I repeat that again. I know a lot of people already struggle to look at numbers and look at accounting, right? And luckily, I love numbers. I'm an engineer by training, but I love numbers. I realized that more and more, I used to be so hung up in numbers, but now 75% of the time I spend is actually thinking about the qualitative aspects of the company. It's not easy, and it's constantly learning for me, right? But I think when you have that skill to evaluate qualities of businesses, that's where you really become the 1% of investors in the world, all right? You don't need to buy at the right time as well. You don't need to be absolutely perfect on your timing. Even if you bought SKP after they got the Dyson contract, not before, right? You still made 26 times your money, 26 times. I don't know about you, but I'm very happy with even 20 times or even 10 times my money. But let's just say almost everybody is not that good. Let's just say in 2009, you're still skeptical and you wanted to see. Right after Dyson got that contract, you said, don't worry, first year, let's see how they execute first. You bought it 3 years later, okay, in 2011, until today, your gain is still 11 times, guys. Now, I don't know about you, if you're happy playing in a 5-10% space, go right ahead. There's no right or wrong in investing as long as you make money and sustainably. But if you want to look for those multiple bagger gains, this is what insights I can share with you, okay? Not all criteria must be met to be successful. Like, for example, Yinsen and Time.com, ROIC was not above 8%. And last but not least, the key criteria is really patience, guys. You don't get a multi-bagger within 6 months or 3 months. Sometimes you don't even get it within 3 years. But if you can hold past that 5 years, right, guys, the likelihood of you securing 100% gain on good companies, it's almost close to 100%. Okay? So are you looking at the right number? Remember the earlier part I asked you to look at chart A and chart B, right? Okay? Here's the last conclusion for you. And I found this very interesting because they said, hey, John, you're all giving us hindsight. There's, timing to the market is very, very important. I'll give you a case study to debunk that myth, whether timing is superbly important. I don't believe so. I'll show you this example. Okay. So this is actually Vitrox. Okay. This was the share price from Q1 2015 to Q2 2017, right before the jump. And I purposely put this period because I wanted to show you guys a flat line, right? Roughly a flat line, 160 to probably 230, right? So it's not much difference, a change of probably 80 cents, okay? But was that the right number to be looking at or not? Now, this is chart B. Chart B was actually the earnings per share of Vitrox. Now, as you can see, the blue line, look at the revenue, guys. Is the slope going upwards or downwards? Very clear, right? Now, you compare this, this is the share price chart. This is the revenue and net profit chart. Okay? So, if you had done the data, right, it would have jumped to you like a gun. It was so clear, right? And the market actually waited for you. 2 years. 2 years, guys. Okay? So, look at that. If you had a good 2 years before the share price jump, if you just look at the growth of revenue and the growth of earnings, right, you would have picked it up. Right? It's so side. But most people, what do they focus on? They focus on the price chart. They try to draw some lines and try to... Yeah, technical analysis can help you understand market psychology, but at the end of the day, you're buying a company that has a business. And these are the business numbers that you should be looking at. So Sorry, in a way, I tricked you guys, but it was actually chart A and chart B is the same thing. You're both buying the same thing, which is VTROX, but then what were the numbers you were looking at? If you were looking at chart B and you were looking at the revenue numbers and the profit numbers, this will help strengthen your confidence to hold this company. It was a multi-bagger after that. You guys know that, right? Okay. So this was a flat line. Okay. So I hope you guys learned something today. I hope that my sharing helped you become a better investor. We do share weekly, at least twice a week on our YouTube channel. We do post Facebook and Instagram posts to help the community invest better. So those are our social media handles you can find out. And we do have a free stock masterclass coming up. Next week. Next week, by the way. So scan that QR code and register. I'm going to open the floor now to questions. So Mr. Moderator or Miss Moderator, thank you for hosting. I'm happy to take in questions for the next 10 minutes, I guess. 10 to 12, 15. 10 to 15 minutes to be able to, answer your burning questions. So Jenny asks, will there be a situation you found a potential stock but it's rarely been noticed by the market and hence the stock price didn't reflect? Yeah, you have to do the work. You have to put in the work. You have to crunch the numbers. You don't focus so much on the stock price. Focus on the business numbers first. Put it on your watch list. And that will give you the conviction to buy before it goes, right? Is that the only question? Kopitiam, I'm looking back at some of the responses. Doesn't seem to be a lot of questions. It's good. I can end the session earlier. Does average free cash flow against market capitalization gives you a better hint on valuation? Yes, it does. Actually, most of the time, I focus on operating cash flow rather than free cash flow. Yeah, I focus on operating cash flow, then free cash flow. Obviously, it's a favorite number by Buffett and a lot of great investors. But I'm just giving you guys the concept that return on investment. If a good company, right, you will know that net profit and free cash flow over the long run, it will match. Now, I find this a lot. I know you guys will find this a lot hard to believe, but great companies over the long run, net profit and free cash flow will meet each other actually. Yes. So, topic at question, and I wanted to answer this. For PE valuations, does the number of shares outstanding have an impact on valuation? The short answer is no, actually. The short answer is no, because if you take market cap against net profit, which is also another way of finding PE, you actually discount the need to have the number of shares. So a lot of people focus so much on earnings per share divided by price per share, right? Use the better formula, which is market cap divided against the net profit, total net profit of the company. Then the number of shares doesn't really matter. That's the PE of the company. And as an investor, that's the number you should be looking at. Don't think on per share basis. You always think on market cap basis. That's a hint. It took me 2 years to really understand this concept. I'm hoping that you guys don't repeat the same mistake I did. Okay. I think I've answered the average free cash flow. I don't give stock picks. I think that's something that you guys have to figure out yourself. All right. I'm scrolling down to see what other questions are there. Okay, yes. How do you determine the price, the time to sell a stock? Well, if the owners aren't exiting, I'm not exiting as well. Remember, I mentioned this part about ownership of the company, skin in the game. If the Kun family, if the Gan family are not selling and 90% of their net worth is tied to the company, right? Why should you and I be selling? Unless they're exiting, then maybe it's a good consideration. Unless they are overvalued, meaning you reach a point where you've already made 50 baggers and you say, hey, yeah, I want to find the next bagger. There's no harm selling half, or no harm selling 25%, or no harm selling 80% and keep the remaining 20%. I think today, this morning, when I was preparing for this, I was reading, my usual morning routine. I always read, I catch up a lot on reading. And I found this article very interesting because it talked about Buffett and he was just announcing his quarterly portfolios. He regretted selling Apple. Charlie Munger told him not to sell a portion of Apple, and he sold a portion of Apple if he didn't sell, he would have made an additional 26 billion or something. Yeah. So if it's a good company, owner still in it, business stays the same, story stays the same, I wouldn't be selling. All right. So there's a question from Anonymous. What are the things that are most important to look at? I'm a beginner. What are the most important things? Upskill. Learn how to read financial statements. I never came from an accountancy background. I've never been into investment banking. I don't have a CFA charter to my name. But I love understanding businesses first. Once you understand businesses, and once you understand how to understand businesses, which is reading financial statements, then the numbers will make sense. That's why you become a better investor. Okay? When the revenue is upward trending but profit doesn't follow the same percentage, does that mean the profit margin is going down? What is your call on this? Great question. We've seen companies where, I'll give you the other extreme example first. Revenue is flat, but net profit margins are increasing. Fantastic company. You know that there's only two reasons why it goes up. Either they've increased, the quantity remains stagnant, okay, but selling price has increased, or they have managed to reduce costs of their particular services or particular raw materials cost. That's why margins is increasing. For the scenario that you gave where revenue is growing, but net profit is going down, I will be wary because of a few things. Now, I think in our YouTube video, probably 3 weeks ago, we talked about server dynamic. Revenue is just through the roof, right? But then you see net profit going down. The first thing I would check is the receivables. Are they actually just growing sales because of sales but not collecting their money? That's a big red flag to me that I will check. Because revenue is one of the easiest numbers to fake, actually. Second easiest to fake is actually net profit. So don't just rely on one number, but it's a great question because it gets you thinking about how financial reporting is about multiple figures that you have to piece together, string together. Okay, great question. So, hi John, do you recommend 2 books by Peter Lynch for a beginner? What are the titles, Cindy? Very easy, just Google Peter Lynch books. There's only 3 books written by him. The first one is called One Up on Wall Street. The second is called Beating the Street. I repeat, highly recommend you to read those 2 books. A lot of great investors started their journey by reading Peter Lynch's book, actually. Great. Monish Prabhai was one of them, okay? Let me see. If I miss any questions, let me go up or down. So the next question is, do I look at the book value of a stock? Yes and no. So when we look at certain ratios, you must really understand the business. Now, I'll give you an example why book value doesn't work all the time. A good example is Genting. Okay, Genting, they had this thing called Star Cruises as part of the business. So if you look at book value, when they bought these cruise ships, let's just assume that they are 500 million per ship, okay? And when you bought 4 of these ships on the books, it would have been 2 billion. When times are great, everyone is taking a cruise. The book value seems reasonable. The moment a COVID-19 hit them, do you think they'll be able to sell their ships for 500 million each? Or even 400 million each? That's where book value doesn't really make sense already. That's where understanding of a business and understanding what is in the book value, the asset quality within that book value, to be able to give you a glimpse of whether this is a good metrics to use. So don't apply it blindly. Apply it in the context of the industry and the business. Okay? Any good publications further learning from this? Tons, guys. As I mentioned, worldwideweb.firl.co, FIRL.co. We are revamping the website. I think give it another 2 weeks. We will have a list of all the books that I find great. I can't list them all here. The website would show you at least 20 books that we highly recommend for you to start your journey. Okay, so head on to worldwideweb.firl.co. You'll be able to check our book list there. Okay. Any good tips? Hi, John. Any good tips to train myself to be patient enough after pick a good value stock for a few years despite the noises from the market? Yes. Do all other things except look at the stock screener and the stock price. So I give you an example. So I manage my own family fund. My parents, my sister, myself, and my wife. All separate portfolios. The laziest one I've managed is actually both my parents. I hardly look at them. And in my parents' portfolio, there have been at least 3 stocks that are multi-baggers already. 3 stocks. And why I use my parents' portfolio as an example is because I log into them probably once every 6 months. I repeat, once every 6 months, just to tidy up the dividends. The other times I just leave it. And there was a period of time when I was so busy in my career when I was working for Shell, I did not log into the account for 2 years. Guess what? The savings account in which the dividends are deposited into in your savings account is a separate account. It became dormant. It became dormant that I had to get my parents to go to the bank to reactivate it. So that's a hint to you on how you can be patient. Do the work upfront. Find great companies. Read up about the company's progress rather than look at the share price. If you can do that well and you just look at that rather than looking at share price, right? I tell you, you will increase your patience by a lot more. Okay. Okay, I have to scroll down again to look at the questions. Great questions, guys. By the way, keep them coming. Stagnant share price while net profit is growing could be a sign of PE overvaluation. How do we differentiate between overvaluation or good companies to load more? Understand the TAM, understand the moat. And there's a lot you can, there's this company that I've been studying for a long time. And I thought I knew the company after studying it for 3 months, right? I only realized after attending my 3rd AGM with them that I really understood the company. So once you understand a company, a few things will happen to you. You will also understand the industry. And when you understand the industry, you understand the moat better. You understand the TAM better. That's how you should be looking at valuations. Rather than just figuring out the PE, you need to figure out the TAM. Is it something stagnant today that while net profit is growing, but PE is like overvalued? You want to understand how big this company can grow. I invest in the US. I have a US portfolio, and one of the companies I regret not buying was Netflix. I'm a fervent subscriber, and yet what put me off was because the PE. It was too high. It was never at a PE that was cheap for me, and I missed out on a 120 bagger, actually a 150 bagger, right? So just to showcase to you that don't be hard out on just one number, okay? Let me scroll down again to look at the questions. We've got another 2 minutes, I guess, 1 minute, okay? Oh, do you mind? I think Chu asked a very good question. Do you mind sharing your most painful experience in investing? What did I learn from there? The most painful experience I had was losing 25,000 ringgit when I didn't know what I was doing and I was looking at charts. And I went into margins. Yeah. So I bought this 3 company. I don't mind sharing because I've publicly mentioned them before. I bought this company called K&M, Brahmins, and this company called Ralco. I didn't know how to read an annual report. I was just learning how to read charts. And I followed a lot of tips in the market. So things like, what was it? Buy on rumor, sell on news. I'm pretty sure a lot of you have heard this, right? And what happened is I was so confident, I went in margins. And instead of buying just with the money I had, I bought 3 times more than the money I had. And 25,000 ringgit when I was 25 years old, guys. And from that moment onwards, for me, when I look at anything that can help improve my skills, right, I would gladly pay for it. Because that 25,000 ringgit tuition fee, I gladly pay for anyone or any system that can help me be a better investor. I'm a ferocious reader. I'm a ferocious podcast listener. And when I listen, right, and I listen to fund managers in the US and in these hedge fund guys, my goodness, the mental models that they have compared to what we as investors have in Malaysia, or even fund managers that we have in Malaysia, there's so much more to learn. I'm constantly a student in the market. And why it relates to the painful investing is that you constantly become better. So when I first started understanding how to do basics of value investing, I look at all these basic numbers. But as more and more I grew, right, I realized that numbers only make up only a fraction of that. And my plea to you is never stop improving, never stop learning. Okay? Moderator, let me know in the chat whether I have another, how much time left to answer questions. I can cut it off anytime, all right? How can we identify good companies when they are low PE? Because companies I'm studying have growing net profit, but high PE as well. Now, don't focus so much on PE again. Like I said, not to say that PE is not important, but make sure you understand, is the PE actually justified? Never pay for overvaluations. Can you imagine paying for a company that is 100 PE, but the earnings is actually only growing 5 or 10% a year? So if you do the math, right, rule of 72, 5 or 10% a year, let's say 10% a year, you're doubling your profit every 10 years, So if you're paying of 100, that means only after 10 years, the PE becomes 50. So that's the mental model I use. If they're growing earnings at 50% a year or 70% a year, that means every 1 year they double the net profit. So if they double the net profit every 1 year at a PE of 100, next year will be 50 already. The year after that will be 25. That's the mental model I use. Okay, hopefully with this short answer, yeah. If you found you have a good bagger stock, when you do decide to sell it off or hold forever, I think I've answered that earlier. If the owner is not leaving, why should I? Is there a proper framework to start investing and manage your portfolio? Yes, there is. Head out to our YouTube channel or Fira.co. We, over the years, MJ and myself, I've shared my experience and taught close to more than 5,000 students over my very short period of teaching and sharing over the past six years. And one of the things that I found a lot of investors like is that they have so much of information. Today with Google and YouTube, there's so much information, so much opinion. The thing lacking that they have is actually a system. And what we found that even though we're constantly learning and constantly improving ourselves, is we set down a very systematic way of how to evaluate and how to manage your portfolio. And I think that's what a lot of courses out there actually lack, because one, they may be very good at teaching, but do they manage money? I think that's the question that you should ask yourself. Do they manage their own money? Okay. Last question, I think. Newbie here, where do I get apps for paper trade? I would discourage you from paper trade. I know a lot of times people out there will tell you, hey, you should do paper trading, start for starting all this kind. I would rather you put in real money that you can lose rather than paper trade, because the emotional response when you paper trade versus that of real money will be very, very different. But don't start out with money that you can't lose. Start out with money you can lose, $1,000, 2,000 ringgit, right? But make sure you upskill yourself first. Because if you don't upskill yourself, it's like going on the road and driving without a license, or jumping in the pool and you don't know how to swim without a life jacket. So I really hope you guys, the key takeaway is upskill yourself first before you start doing this paper trading or whatever. Okay? I think I've answered all the questions. I think moderator, thank you for moderating and putting forth the interesting questions. If there's no other questions, as I said again, if you guys want to learn more, our social media handles are there. There's a free class next week. We even talk about companies like Microsoft. So I'll see you guys in the next session. Happy investing and have a great weekend.